Throughout history, global economic crises have shaken not only markets, but also transformed lives and societies in irreversible ways. The 1929 Great Depression and the 2008 global financial crisis were the dark days of capitalism. In this documentary, we will explore the hidden causes, the aftermath, and the lessons learned from these two monumental economic collapses. Economic crises have been a recurring theme throughout history. From the 1929 Great Depression to the 1997 Asian financial crisis and the 2008 global financial crisis, each collapse shook the very foundations of the global economy. What were the common threads in these crises? How could entire markets crash, banks fail, and millions of lives be upended seemingly overnight?
The roots of an economic crisis typically lie in long-term imbalances in the economy. These imbalances, when combined with speculative bubbles, credit expansions, and unchecked borrowing, often lead to inevitable collapses.
History shows us that financial markets can rise quickly, but they can collapse just as fast. Crises occur when risks that were ignored during periods of growth and prosperity suddenly come to the surface.
The 1920s were a golden age of economic growth for America. Everyone was making money in the stock market, but this boom was turning into a speculative bubble. People were buying stocks on credit, and banks were turning a blind eye to the risks. In October 1929, the Wall Street stock market crash triggered one of the largest economic crises in history. Billions of dollars were wiped out within days. Investors lost their fortunes overnight.
The Great Depression was not just a financial collapse. People lost their jobs, their homes, and their dignity. The American economy came to a virtual standstill.
Millions of Americans were left unemployed. Poverty and hunger became everyday realities. The social and psychological impacts of the crisis would be felt for generations. In the early 2000s, the U.S. housing market was booming. Everyone wanted to own a home. Banks were giving loans to anyone, even those with low incomes. This was the beginning of a new bubble, the subprime mortgage crisis. In 2008, the collapse of Lehman Brothers exposed the fragility of the modern financial system. The fall of this financial giant triggered a domino effect that rippled across global markets. This crisis didn't just affect banks and financial institutions. People lost their jobs, their homes, and their livelihoods. The global economy plunged into a deep recession. Behind every crisis are the human stories, the millions of people who lost their jobs, their savings, and their sense of security. To understand the true cost of these crises, we must listen to their voices.
One day I went to work and the company was shut down. A place I'd worked at for 15 years had gone bankrupt without any warning. I lost everything overnight.
After each crisis, the world economy struggled to recover. Central banks stepped in with monetary expansions to revive the markets, and governments introduced massive bailout packages.
Post-2008, reforms like the Dodd-Frank Act were implemented to make the financial system safer. However, the weaknesses of the system haven't completely disappeared.
Today, the world faces new risks. Cryptocurrency bubbles, income inequality, and climate change are seen as potential triggers for future economic crises. What lessons should we take to prevent the next collapse? Throughout history, economic crises have repeated, but humanity has learned lessons each time. To prevent similar collapses in the future, we must apply the lessons of the past. Because a crisis doesn't just disrupt markets, it changes lives.